This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now let's go through and look at the group statement of profit or loss and other comprehensive income. So throwing in the other comprehensive income is just a little bit extra from what you've seen previously, is it there at F1. Remember what you've got again is the big difference here is that your profit or loss tells a story, doesn't it? So it tells you what's happened, isn't it, for that 12-month period. So when we come to some of the later bits, it's important that you understand when the acquisition date is of the subsidiary. Everything that you've got in terms of the profit, again, shows you the level of control. So what you want there, isn't it, is 100% of P plus, is it 100% of S? And we do that on a line-by-line basis. Remember that any investment income that there is in the parent's book that's been received from the subsidiary, we ignore it, don't we? Okay, so there's some familiar line items in there: revenue, cost of sales, other income, distribution. I'll stop there. Okay. You do also see a share of profit of associate. You'll see that a little bit later on. Is it in chapter 7 when we look at the associates? And then what you have there is your other comprehensive income. And again, we want to go through there and show control, isn't it? There's a lot of items that go through other comprehensive income there. Maybe, pardon the bad pun, it's a bit too comprehensive at this point in time, but it works in exactly the same way. And the one that I'll just focus upon are your gains on property revaluation, because that's what we've seen when we've revalued PPE previously in F1. Any gains go to other comprehensive income, don't they? Because they have not yet been realised. So again, what we do there to show control, we put in 100% of P plus 100% of S. Okay. Again, line by line basis. There's a couple of others. They look quite horrible, don't they? That you'll see later on. Okay. Again, just note at the bottom there's that share of other comprehensive income of associate, which you'll see in chapter 7. Okay. What you do is you take the profit for the year and you go through there, don't we, and add the other comprehensive income to give you your total comprehensive income for the year. Okay, so that's the total profit plus the total other comprehensive income. Then what you do underneath, that's whereby we then show ownership, isn't it? So the ownership, we split it out into two aspects. We look at the profit, which we've seen before in F1. So to work out the non-controlling interest share of the profits, you take the non-controlling interest percentage and multiply it by S's profit for the year. But now what you have just a little bit extra is, as well as the profit, you also need to split out the total comprehensive income. So what you do there is you take the non-controlling interest share and you multiply that by S's total comprehensive income. S's total comprehensive income is including S's profits plus S's OCI. So adding the two together gives you S's total comprehensive income, and you can work out then the non-controlling interest share of that. Once you've got that, you can then work out the amounts attributable to the owners of the parent as a balancing figure, taking the group total comprehensive income figure, so is it this, and then deducting that non-controlling interest figure that you've just calculated. Okay, not much to it really. The adjustments that you have, the mid-year acquisition, key bit there is that if you have a subsidiary and it was bought partway through the year, you can only consolidate from the date that we have control. So therefore you need to prorate the results, don't we? So if you're looking there at the subsidiary, you need to make sure that you put in 100%, but you need to prorate it by X twelfths based upon the number of months. And you prorate everything: revenue, cost of sales, admin, distribution, right the way down. Okay. Intragroup sales, Again, that was something that was quite nice, wasn't it, from the days of F1. If there's intragroup sales between the parent and the subsidiary, you eliminate those intragroup sales for the year. So you need to remove your revenue, debit the revenue, and credit the cost of sales, which reduces cost of sales. So if you like that, on your revenue, it's 100% of P plus 100% of S. And then we deduct my intra-company sales. For cost of sales, again, it will be 100% of P plus 100% of S. And again, I deduct my intra-company sales. Okay. Everybody happy with that there? Okay, same figure that we adjust through revenue and we adjust through cost of sales. Provision for unrealized profits. Again, you work out the PUP based on the markup, based upon the goods that are still in inventory at the end of the year, and that is adjusted through your cost of sales, isn't it? Because you're debiting the retained earnings, which reduces your profits. To reduce your profits, we're going to increase the cost of sales. Okay, so your PUP adjustment is an increase to your cost of sales. So you would add in your PUP adjustment there. Okay. Dividends, I think we mentioned that briefly earlier on, just at the start of the chat. If you are the parent and you've received a dividend from the subsidiary, you know, the dividend that you will have received will be P's share of S's dividend, won't it? So if the subsidiary paid a $1 million dividend, you own 60%. 60% of the 1 million is 600,000, isn't it? That's a dividend that's gone from here, the sub, to the parent within the group, isn't it? We're not worried about what goes on within the group. It's only that we're interested in what goes on with the group and the outside world. Nothing has gone on with the outside world. It's all internal. So we eliminate it. Okay. We want to show any investment income in profit or loss that is external only, isn't it? Okay. And then right at the bottom, I suppose that's new. Save the best till last. In the earlier examples that you saw in the statement of financial position, you saw us make that adjustment for depreciation, didn't we? For however many years since the date of acquisition, because in the SFP it is cumulative. Just be aware here that in the statement of profit or loss, we need to make sure that it is just 1 year that we adjust for on the additional depreciation on the fair value adjustment. So just be careful. If we bought the subsidiary 3 years ago, on the SFP, there will be 3 years accumulated depreciation to adjust for, but in profit or loss, we only take 1 year. Okay, so do just be careful. So there, any change in the fair value of the assets or liabilities is accounted for in S's column. So we'll talk about how to present things as we go through the examples. So we make an adjustment to S in the group accounts in the consolidation schedule. And the common one that you have there, as we said, is that extra depreciation. Okay. Sounds a lot, doesn't it? But as you work through the examples, you'll find that it's not as much as what you actually think, because a lot of it has been seen before at F1. Okay. Whatever you do, don't go back and look at all your F1 notes and think, I've forgotten it all. No, we're just covering it to make sure you're happy, so that you've got a revision and a good understanding of what you've previously done. You will get better at the stuff that you may have forgotten as you do more of the questions in the F2 revision bank. Okay, so yeah, don't go back and do anything F1 related. Just stick to what you've got in F2 and you will be fine. Trust me. So have a go on the examples that you've got on the following pages. The following example goes through and looks at preparing a full consolidated statement of profit or loss. And the reason why we look at preparing the full financial statement, even though you're not going to get examined in that way in the exam, is just so that you have an overall big picture of how everything fits together. And then once we've understood that, we'll then see in the later examples how bits and pieces can then get pulled out from the big picture in terms of how you then get examined. Okay, so it is worthwhile looking at the full financial statement consolidation. So here what you've got, as we've said, it wants us to look at the statement of profit or loss for the Edinburgh Group. So Edinburgh must be the parent, and it wants it there for the year ended, is it the 31st of December 20x5, isn't it? Okay, so we know Edinburgh's the parent. It tells us in the additional information Edinburgh acquired 80% of the equity share capital of Glasgow, so Glasgow must be a subsidiary. Key bit is that is on the 1st of July 20x5. Year ended it's December x5, so we have, is it July, August, September, October, November, December. So that there is 6 months, isn't it? So we will consolidate 6/12 of the results of Glasgow. And we also own 75% of the share capital of Aberdeen several years ago. So you don't need to, but you know, we're going to not make any adjustments to Aberdeen's figures. It's there as 12/12, isn't it? Okay. So Glasgow's gets prorated, Aberdeen's doesn't. It says Edinburgh sold goods to Aberdeen, so that's the parent selling the goods, invoiced at 10 million, so that's some intra-company sales that will need to be removed. And it says there's a markup 25% and all of the goods remain in inventory, so we'll need to adjust for the full amount of profit on those goods. We're told Glasgow, so is Glasgow the subsidiary, sold goods to Edinburgh. Again, you've got, is it some intra-company sales of 5 million, same 25% markup. All of the sales occurred after the acquisition, so we remove all of the 5 million as intra-company sales. And again, the key bit that you have there, half the goods remain in inventory. So whatever profit you work out on the sale, you adjust for half of them. And again, we need to make sure that we adjust within the correct set of books. Okay, so if the parent sold them, we adjust the parent's cost of sales. If the sub sold them, we adjust the sub's cost of sales, don't we? Okay, excellent. So let's go through, have a go at it, see how we get on. So what we've got is we're going to go through there and look at the revenue. Is it there of the parent and then the two subsidiaries. We then have the adjustments column before we then get the group consolidated column, don't we? So the revenue of Edinburgh is that 200. Again, just be careful for that first subsidiary. Was it there as Glasgow? We put in 6/12, so is that 120? And Aberdeen, we put it in full, that is also 120, isn't it? The adjustments are the intra-company sales, so we deduct 10 and we deduct 5. Okay, if you go through, total that up, does that give you there, is it 425? Okay, that's your group revenue. The group cost of sales, you've got 100% of the parent at 120. Glasgow, we put in half, so 6/12, so is that 80. And then we put in all of Aberdeen at 50. And then we adjust, is it for the intra-company sales, isn't it, of 10. And 5, okay. Just be careful, there are also some PUP adjustments that we need to incorporate. One of the PUP adjustments, wasn't it, was whereby the parent sold the goods. So the parent sold the goods was at 10 million, 25% markup, and all of them are in inventory. So the first one there on my PUP was whereby Edinburgh, the parent, sold the goods to the sub Aberdeen, and the PUP that you've got there is 25, is it 125ths of, was it the 10 million? So is that there as 2, isn't it? So that 2, Edinburgh is the parent, So we will adjust, is it Edinburgh's column? And none of the others. The second pub adjustment that you had, I think, was when Glasgow sold some goods to Edinburgh, and Glasgow is the subsidiary, isn't it? So we'll adjust Glasgow's column. The amount of goods that were sold, I think, was 5 million. So this markup 25 125ths multiplied by 5. But remember, half of the goods had been sold, so half are left in inventory. If you tap that into your calculator, I'm reliably informed that that is 0.5, isn't it? Okay. So 0.5 is then what appears, is it in there? And you then just need to be a little bit careful, don't you, when you're going through and working out the cost of sales figure. So what have we got? 120 plus 2, plus 80 plus 0.5, plus 50 less 10 less 5. Okay, does that go through there and give me, I put it in the correct colour, 237.5, which then gives me, is it gross profit, is it of 187.5. You've then got, I think, is it your operating expenses? The operating expenses, is it there? I think it's 30. Is it 15 because we put in half of Glasgow's figures? And is it also 16? Okay. Careful. Nope. 32. Apologies. We put that in full, don't we? Okay. So 30 plus 15 plus 32. Does that give me 77? Okay. Which gives me operating profit of 110.5. Next line item that you have, is that there your tax? So is that 10, 6 twelfths of Glasgow is 5, and then the 8. 8 and 5 is 13, 10 is that 23. 110.5 less 23 gives me 87.5. Okay, excellent. I then need to go through, don't I, and total up everything to do with the subsidiaries. Again, correct me if I'm wrong, but I think we have, is it 19.5 in Glasgow, and is it 30 in Aberdeen? Of those figures, we own, was it 80% of Glasgow, so we need 20% NCI on the 19.5, and I think we owned 75%, was it, of Aberdeen. So the NCI share is at 25. Okay. So what we've got there is that those amounts need to be split, don't they, into the amounts attributable to the parent and the amounts attributable to non-controlling interest. So I think you've got 3.9. Is it 7.5? When you add them across, that gives you 11.4. And if you tap in the answer, then I think the balancing figure is 76.1, isn't it? Okay, there we go. Excellent. The 76.1, if you're curious as to where that comes from, that there is the 87.5 less your 11.4 of the non-controlling interest. There we go. So that's a full-blown consolidated statement of profit or loss style question. What will get examined, any line item could be asked for within a question. So, you know, there's nothing to stop the examiner turning around, giving you the information and saying, oh, careful, right, what's the revenue figure? Okay, So you need to take 100% of the parent, 100% of the sub, prorate if there's any mid-year acquisitions, and then adjust for any intra-company sales to get the revenue figure. Could ask you for cost of sales figure, which would be quite a challenge, because as well as adjusting for the intra-company sales, you've also got PUP adjustments to consider as well. So that will be one of the trickier aspects within the exam. But if you have a good understanding of how it all pieces together, whatever the exam question is, you shouldn't get too much difficulty. Okay, you should be able to pull out the bits from the overall bigger picture. Other than that, keep working through and keep working hard. Enjoy.